All right, so let's discuss about various types of investments. I am your presenter, Sayed Mohyuddin, but most people know me as Miles. Okay, just a disclaimer, this webinar is just for education purpose only. This is not a step-by-step guide for investment or any sort of advice, nor we are any affiliated in any form with any particular company or mutual funds. All right. So let's begin. These are our today's agendas. Okay, we will be discussing about what are the different tax saving investments are, mutual funds, SIP, that's systematic investment plan, as well as what are the things that you should know before you start investing in mutual funds. What are the risks? What are the things that you need to keep in mind? So let's begin with a little bit of introduction about myself. My name is Sayed Mohyuddin, again, as I said, but most people know me as Miles. Okay, I am an international recruitment manager and I have been working in recruitment industry for more than 10 years now. I have recruited for multiple different countries that includes India, domestic recruitment, as well as Americans, both North American and South American. I've done recruitment for UK, Canada, Australia as well. So multiple APAC regions, North American regions, South American regions, and Australian regions, as well as European regions as well. Currently, I am working for a company named Soft HQ, and I am the head of operations and head of HR management at that company. Right. So let's begin with our first topic. That's what are the different types of tax saving investments are there in India, and are they really beneficial to you? What sort of scenarios will apply to you, and how can you save your tax by investing in these module? Let's start with different types of investments. Okay, usually these types of investments are especially for salaried employees, people who are working on salary basis. You can use these investment to save your income tax mostly by applying section 80C while filing your tax. A lot of time your tax is deducted at the source, that is known as TDS. Generally when you receive your paycheck or your salary, usually your tax has already been deducted at the source. So that is why it's known as TDS. Now, you can use section 80C to reduce your income tax, to reduce your TDS, and at the same time, you can use the same 80C to file for your income tax return and get your income tax refunded as well. Generally, 80C can help you save up to 1,50,000 rupees per year. Let's say your tax is getting deducted about 2.2 lakhs a year. Out of those 2.2 lakhs annually, you can save 1.5 lakh per year by investing in 80C. Now let's see what are the different types of investments are there which are eligible for section 80C. But before we do that, these are few of the things that you need to keep in mind. Okay. While this method might be very suitable for you, it might not provide a suitable return for you as well. That completely depends on what kind of investment that you're taking on, and at the same time, what kind of risk are you taking with your investment, and what kind of returns that you're looking for. Okay, so when you're looking for returns on this investments, they can also be taxable. So you need to keep that in mind as well. And additionally, you can avail for different tax benefits using these methods even on the market's average lows as well. Now, here are some of the tax saving investments. Okay. First, you have your tax saving investments. Second, you have your education loans. Next, you have your long-term capital gain investments. Next, you have your charitable donations. Next, you have your deductions on various different expenses. Then you have your home loans. And then you have your house rental allowances. And lastly, you have your leave travel allowances. These are the various different methods that can help you save your income tax. Let's break down each and every model and, and discuss in further about them. So let's start with the tax saving investments. There are various different types of tax saving investment, again, which section 80C will apply to you, and you can save up to 1,50,000 rupees per year on your income tax returns. Okay, you can use different types of methods, different instruments to invest in these plans, and again, at the end of the plan or the maturity date, you can get your return substantially better than what you have invested. But again, keep in mind, it all comes with a risk. It all comes with a lot of research. These are the various different types of tax saving investments out there. Number one is ELSS. That stands for equity linked saving schemes. You can invest in equity and you can save a lot of tax in that. Again, the limit is up to 1,50,000. Then you have your ULIPs. That's United Linked Insurance Plans. You can invest in various different United Linked insurance plans, and that can help you generate both an income as well as get you covered with various different insurances. And at the same time, that can help you save your tax as well. Next, you have PPF, Public Provident Fund. You can invest in different provident funds, different provident fund in organizations, and you can claim those tax exemptions as well. Then you have Employees Provident Fund, EPF. That is generally done through your employer, where you will be paying for a margin from your salary. And a lot of time, an employer might also match the same amount and invest in EPF as well. Then you have your traditional insurances, various different kinds of insurances. You can invest in those insurances and then get yourself covered. At the same time, you will be able to save your tax as well. Next, you have your National Saving Certificate. You can apply for National Saving Certificate. You can invest money in National Saving Certificate, and then you can save your tax as well. Then you have your Sukanya Samriddhi Yojana. You can invest in this government scheme to save your tax as well. And then you have your National Pension Scheme. You can invest in a national pension scheme through your nearest post office, and then get a steady income when you retire as a form of pension. At the same time, you will be able to save your tax as well. Next is senior citizens tax saving. This applies to most senior citizens, where they can apply for this scheme and save a lot of tax. And lastly, you have your fixed deposits. You can invest in long-term fixed deposits and you can save a lot of tax as well. Now let's discuss about in detail about each and every method. Let's start with ELSS. That's equity linked saving scheme. Equity linked saving scheme, or ELSS, is a type of mutual fund scheme that primarily invests in stock market or equity, meaning this this scheme I'm sorry. Yes. So what it means is you can invest in various different stock markets or equities to save your tax. And again, you can save up to 1.5 lakh rupees per annum by investing in ELSS mutual funds. Okay, again, you can apply for these tax savings on section 80C and you can save your income tax. There are a lot of advantages with ELSS. The one of the biggest advantage that we have right now with ELSS is that the lock-in period is just for 3 years, meaning when you invest your money will be locked for just 3 years. Unlike any other investments where you have to lock your money for 5 years or 10 years or 15 years, ELSS give you a very short period of short amount of time, just 3 years to get your to reach the maturity date and receive your investments along with your potential additional income. Okay, so in this method, you can sell your investment after 3 years, and you can maximize your return if you're able to invest for longer period of time. Instead of 3 years, if you're able to invest for 5 years or for 6 years or 10 years, you will be able to get much better returns as well. But again, the minimum lock-in period is for 3 years. Any questions so far about ELSS? Any doubts, any confusions? Nothing? All right, let's move on to the next.
No, we are good.
Okay, now let's discuss about unit-linked insurance plans, also known as ULIPs. ULIPs is, as it sounds like, okay, it's about various different insurance plans. This insurance plans help you invest in both equity or else various different kind of bonds, and at the same time it will also invest in insurance to give you proper coverage as well as to give you proper returns or income as well. Generally, whatever premium that you pay for ULIP, and that's going to be on monthly basis, whatever premium that you pay on ULIP, usually that's divided with 50-50 in different things. So 50% might be invested into equities or bonds, and remaining 50% will be invested towards your insurance, so that you will have an insurance to help you provide coverage. At the same time, it will help you invest in various different stocks and bonds and help you earn money out of it, help you gain returns out of it. Okay. Generally, these insurance are life insurances. So let's say you opt in for a 20-year insurance plan, 20-year investment plan with ULIP, and you're investing on monthly basis or quarterly basis or half yearly basis, or if you're going for an yearly based plan, which means if you're investing money, lump sum money every year, usually a date will be decided, whether it's monthly, whether it's quarterly, whether it's half yearly, or whether it's yearly. A date will be decided with by your investment company or investment organization, and on that date they will deduct the premium from your account. So let's say you opt in for a 20-year plan, and due to unfortunate circumstances, you passed away, let's say at the end of 15th year. When you pass away at the end of 15th year, your family will receive, or your beneficiary or your nominee, whoever you have mentioned in those documents, will receive a lump sum amount of both from the life insurance as well as the remaining, or the returns that you have received over the 15 years of investments. So your beneficiary will be receiving the lump sum amount from the insurance as well as from the investment that you have made in those 15 years. And luckily, if you survive those 20 years and you have completed your payment process, at the end of those 20 years, you can opt in to receive monthly income, or you can opt in to receive a lump sum amount, or else you can opt in to receive a lump sum amount plus monthly income. So at the end of 20 years, let's say you invested something like 30 or 35 lakhs, and you're getting a return of 1.2 crores or 1.5 crores, depending on market. And you can choose whether you want to receive all that 1.45 crores at the same time as a lump sum amount, or you can choose whether you want to receive it as a monthly income, so that for next additional 20 years or 30 years, or as long as you're alive, you might get 30,000 rupees or 50,000 rupees, depending on what the returns are as a monthly income. If not, you can opt in for a hybrid process like lump sum plus monthly income. In this scenario, you might receive up to 60 or 65% of your investment returns, meaning out of 1.45 crore, you can receive lump sum amount of up to 75 to 80 lakhs, and the remaining 75 to 80 lakhs or 60 lakh, whatever amount is remaining, that will be divided that will be divided between different months, whatever year plan that you select, and you will receive that income additionally on monthly basis. So this is how ULIP can help you both saving tax, creating a solid insurance plan, as well as getting good amount of returns. Any questions here with ULIP? Any doubts, any confusions, or anything that you would like to clarify? All right, let's move on to the next point. That's Provident Fund, also known as PPF. PPF was introduced in India back in 1968. It was mainly introduced. Yes. Yeah. Do you have any questions? Sorry. No. All right. So let's continue. So as I was saying, PPF was introduced back in 1968, and it was mainly introduced to help low income professionals or individual to invest in various different plans and get a guaranteed income out of their investments. Generally, the returns with PPF are considered very low compared to mutual funds or equity investments or ULIP or anything else. But there, the only difference is with PPF, there are guaranteed returns assured with it. At the same time, while you're investing in PPF, you can also apply for an exemption. You can also reduce your income tax for whatever amount that you have invested in PPF. PPF is generally considered as a very safe investment because the risks are very low and the income returns are guaranteed out of PPF. Similarly to PPF, you have EPF as well. That is our next point. EPF stands for Employees Provident Fund. As I mentioned earlier, if you are a salaried employee working for an employer, you can opt in to give a portion of your salary, how much ever amount it might be, maybe 500 rupees, maybe 1000 rupees, maybe 5000 rupees, how much ever amount it is, you can opt in to invest in EPF. And a lot of time, not all the employers, but a lot of times employer also choose to match the amount, whatever you're investing, to invest along with you in your EPF account. And generally, again, EPF are also considered as very safe investments. But again, the returns are very low when compared to investment in mutual funds, stock market, or investment in ULIPs. The only difference is you have a safety guard with EPF. The risk factor is very low with EPF. So the chances of you losing your money with EPF is very low, and there is a guaranteed return that you will get. The amount might be small, but there is a guarantee that you might receive your returns on EPF. Generally, both the amounts that you have invested along with your employer, if they are matching the amount or whatever amount they have invested, are combined and deposited to the EPF organization, also known as Provident Fund Organization. There are multiple different organizations across India. Depending on what organization, what bank, or what sector your employer chooses, the EPF will be deposited to that particular organization. So do you have any questions related to EPF, or shall we move on to the next point? Does anyone have any questions, any doubts, any confusion? Nothing?
No questions. Thank you.
Alrighty. So let's move on to our next point, that is traditional insurance plans. Now, there are different types of insurance plans in the market. For example, money back life insurance plans, endowment life insurance policies, whole life plans, and term life insurance plans. All these insurance plans are very good for tax saving purposes. You can save a lot of money while investing in these type of insurances. All these insurance plans provide you a life insurance coverage for your life in case of your sudden demise, unfortunate sudden demise. Then whatever amount that you have obtained for, whatever investment that you have made for, or premiums that you have paid for, and if you have made your full premiums, then your nominee or the beneficiary will receive the returns in terms of your life insurance. Now, keep in mind, these are life insurances, which means you will not be getting any money in return if you're investing in life insurances while you're alive, unless until there is an option with your life insurance for premium payback. Some companies, some banks provide you an option for premium payback, which means, let's say you took a term life insurance plan for next 30 years or 25 years, and you have paid your premium for, you have selected the premium package for 10 years or 15 years, and you have successfully paid each and every month your entire premium. And after 25 years, you can opt in to receive your investment or receive your premium back. So let's say in those 15 years, you have invested somewhere around 23 lakh or 25 lakh rupees. If that company allows, and if that company has the clause while signing the document that you will be eligible for premium payback, then at the end of the term, you can receive your premium. But if not, then there is no way of getting money back from these insurance policies. But at the same time, these insurance plans are also very important as well. These insurance plans help you cover for your family in case of your sudden death, unfortunate death. These insurance plans can help your family survive even without you. So that is why these plans are very important as well. And at the same time, these plans will also provide you tax reductions or tax savings, especially in your TDS. While filing for income tax, or if your TDS has already been deducted from an employer and have been paid in full, you can apply for tax refunds with the government by showing your premium receipts, and you will be eligible to receive your money back. If not, you will be able to save your income tax or save your income tax deductions. That is why these plans are also very important. One, they provide you tax benefits. Second, they help you survive your family, even if you're not there. Any questions here? Nothing? All right. So let's move on to our next point. That is National Savings Certificate, or also known as NSC. NSC is a fixed income investment scheme that can that you can open at any post office branch, any government post office branch across India. Okay. Usually they will invest your money in savings bond, and usually this is targeted towards small to mid-level or low to mid-level income salaried people. Okay. Either salaried or low or mid-level income people. Okay. And this helped them invest their money safely into government saving bonds. And again, depending on government, this can give you low to moderate amount of returns, but a lot of time these schemes are guaranteed for returns. At the end of your investments, you are eligible to receive your in both the investment that you have made as well as the returns. Maybe it might be 3%, 5%, 6%, depending on the government that they are opting in for. You will receive your investments back from here. Again, it is considered as a very safe bet to invest or very safe place to invest. Next point is Sukanya Samriddhi Yojana. This again has been introduced by our government. Again, this is also a very good tax saving investment. If you have a daughter, if you have a girl child, you can invest for to support her future needs, her future education, and she soul will be the beneficiary of this investment. You can opt in for the age or the number of years that you want to invest for, and these are going to be small monthly deposits that you are going to be making on monthly basis. And at the time of maturity, at the time of investment maturity, meaning maybe 15 years from now, 20 years from now, depending on the policy that you have selected, your daughter will receive the whole lump sum amount. Next point that we have is National Pension Schemes, also known as NPS. This is one of the most famous investment scheme as well. This is again another scheme provided by the government. This scheme is directly under the Finance Ministry of India, and this is monitored by the Finance Ministry of India. This is a volunteer contribution program, which means you can choose whether you want to invest in NPS, and once you retire, you will be eligible to receive your pension on monthly basis based on your investments. Again, NPS is also considered as a safe investment because the risks are very low, and at the same time returns are also very low, but returns are guaranteed. And next we have senior citizen saving schemes. Generally for senior citizens who are at the retirement age, they can opt in for this program, and they can either opt in individually or jointly with other senior citizens and invest regularly to start getting regular income for their investments as well. Again, this is also considered as a safe bet as well because again, this is backed by Indian government, and at the same time, the risk factor is very low with this investment, and returns are guaranteed. Even though the returns might be small, the returns are guaranteed. That is why again, this is considered as a very good investment plan, and at the same time, this will help you save your income tax as well. You can invest on monthly basis, or you can invest a lump sum amount in this as well. And the last tax saving investment that we have in our list is fixed deposit. Fixed deposit are considered to be one of the most secure investment. The most secure investment. Usually you invest your usually you create your fixed deposit with a bank, and you invest a lump sum amount for a steady rate of interest, meaning the rate of interest will not vary too high on yearly basis. The rate of interest might be low, something like 5.5%, 5.6%, depending on which bank that you select. And the thing is, it will stay steady for next 5 years, next 10 years, whatever amount of time that you have selected. The minimum amount of fixed deposit time that you need to select to save your income tax is 5 years. If you are investing in any fixed deposit that is less than 5 years, let's say for 3 years or 4 years, then you will not be eligible for income tax saving. Only if you invest for at least 5 years or more than 5 years, then you are eligible for to save your income tax on investments. Okay. Again, this is considered as the safest place to invest. The returns might be very low, but the returns are guaranteed. And at the same time, it will help you save your income tax as well. So these were the most popular investment types of investment in the market, but there are a lot more tax saving investment methods as well, or schemes as well in the market. But these are generally considered as the most famous one. So do you guys have any questions so far? Any doubts, any confusions, or anything? Nothing? All right. So let's move on to our next agenda. Sorry, next point. Next, you have your insurance loan. So far, we have discussed about how to save your income tax based on investments. Now let's discuss about what are other methods of saving your income tax without investing. So the second method is education loans. If you're paying some interest on your own education loan or on your children's education loan, you can opt in for tax exemption for whatever the amount of interest that you have paid on your education loan. But you have to keep in mind the principal amount, the actual amount of loan that you have taken, the EMI that you're paying. You will not be eligible for the 100% of the amount for tax exemption. Let's say you took an education loan for 5 years or 4 years, and the loan is for, let's say, about 6 lakhs, and your monthly EMI is for 17,000 change. Out of those 17,000, how much interest are you paying? You're only eligible for tax exemption for the amount of interest. So let's say out of 17,000, you're paying 2,000 rupees as interest and 15,000 as principal amount. That 15,000 amount that you're paying for as the principal amount is not at all eligible for tax exemption, meaning that principal amount you will not be able to save any tax. But the 2,000 rupees, remaining 2,000 rupees that you're paying in income, so as an interest for this education loan, for those 2,000 rupees on monthly basis, you will be able to save your income tax. So 2 times 12 is 24,000 per year. You might be able to save up to 24,000, or if your interest rate is higher, the amount of interest that you're paying is higher, maybe 30,000, maybe 35,000 or 50,000, then you will be able to save that amount of tax, that much amount of tax as well. Any questions with education loan? No? Okay. Now let's discuss about long-term capital gain exemption. So if you are investing in a long-term investment scheme, okay, investing in long-term assets or reinvesting your income in tax saving investment that we have discussed earlier, and that is for longer than 3 years or more than 3 years, that investment is for more than 3 years, then you will be eligible to save your income tax per year because of long-term capital gain investments. Okay. The maximum amount of saving that you can do, income tax saving that you can do using this method, is up to 1 lakh rupees per year. And again, as I mentioned, you need to invest for in something that is longer for 3 years, and you should make sure that you have the ownership of this for more than 1 year as well. There are various different types of long-term investment. Again, you can do your investment in long-term fixed deposit, long-term mutual fund deposits or ULIPs, etc. But generally, long-term investment will help you save tax as well. Next method of saving your income tax is charitable donations. You can save your income tax by investing in different relief funds or NGOs or political parties or Swachh Bharat Yojana or Clean Ganga funds or different national funds across India. And you might be exempt from anywhere from 50% to 100% of the amount that you have invested. So let's say throughout the year you have donated, let's say 10,000 rupees, and depending on what kind of organization that you have invested in, you can save up to 10,000 rupees in your investment. But you have to keep in mind each donation should not exceed 2,000 rupees, meaning each donation that you have made should not be more than 2,000 rupees. If it is more than 2,000 rupees and in cash, then you will be ineligible to apply for income tax returns. Sorry, income tax savings. Now, there are a couple of things that you need to have to save your income tax. First thing, to whomever you are donating your money, They should provide you with a receipt, proper registered receipt. The receipt should include the address and the registration number, as well as your PAN number would be required to track your donations and to save your income tax. So again, this is one of the method to save your income tax as well. Now let's move on to the next topic. That is, sorry, the next method, that is deductions on expenses. So depending on expenses that you have, maybe the education fees that you're paying or medical expenses that you have for any kind of illness, or if you are handicapped and if you have any handicap dependents, and their expenses are all tax exempts. So you can submit your receipts for maybe for your education, maybe for your medical bills, or maybe for the handicapped person that is dependent on you, and you will be able to save your income tax for whatever amount that you have invested in. Okay, now you can do both with this method. Either you can submit this document to your employer if you're a salaried employee, and you can reduce your income tax deductions directly from the source, that is TDS. You can reduce your income tax deduction from TDS, or if you have already, if your employer has already paid the full amount of income tax on behalf of you, then you can apply for tax refund, and you can submit the documents. You can apply for deduction on expenses, and you will be able to receive your tax as a refund. Now, now keep in mind, there are a lot of conditions with this method. So I would recommend you to look into the details before directly applying for this tax saving method. You look into the various details, look into the various conditions that are provided, because not all expenses will be considered as tax exempt expenses. So I would recommend research a little bit about it and try to understand what kind of bills will be considered as tax exempt and what kind of bills are not considered as tax exempt. That would be my recommendation for you. Now, next method of tax saving is home loans or house loans. If you are able to purchase a house based on your home loan, whatever the amount of interest as well as the principal amount that you're paying for your home loan, you will be able to deduct that from Section 80C. The maximum amount of tax exemption or tax reduction that you can get per year is 2 lakhs rupees based on this method. Generally, if you have a bigger home loan, there is a chance that you will be able to save bigger amount on your income tax deductions. So home loans are always a good option, because one, it will help you purchase your house. You will own an asset. You will be paying premium your monthly EMIs, but you will own an asset. You will own a house, and at the same time, it will also help you save your income tax as well. Next, we have house rental allowances. So generally, if you're a salaried employee, you will receive your house rental allowances, and generally that is up to 25% of your income. It should not exceed, sorry, it should not exceed more than 10% of your income, and you should not be paying for house rent that is more than 25% of your income. And you can definitely apply for tax reductions for your house loan that you have paid so far. Any home loan, sorry, any house rent that you paid, you need to have proper receipt for your monthly payments, and then you can submit those receipt and reduce your income tax. Keep in mind, keep in mind if keep in mind if your house rent exceed 10,000 rupees a month, then you need to get a copy of your house owner's PAN card, because they will be eligible for additional income tax, because they are receiving a huge amount through rent as an income. So you need to submit your owner's PAN card copy. to if your house rent is more than 10,000 rupees a month. So you have to keep that in mind. And the last method of saving your income tax is leave travel allowances. So generally, if you're traveling with your alone or with your family, or if you're on a business trip, you will be able to save a lot of money by submitting an expense report, by submitting all your bills that concurred during your travel, and you will be able to save a lot of income tax based on your travel. But keep in mind, you can only do 2 domestic travels in 4 years. The limit is for 2 domestic travels in a period of 4 years. If you're traveling more than twice in 4 years, then you will not be eligible for income tax reductions. So keep in mind, this method also helps save your income tax, but it's only allowed for 2 times every 4 years. So these were the different methods, different methods of saving your income tax. Any questions on these? Any doubts? Any confusions or any point that you would like to discuss? Or any additional information that you would like to know? Nothing? No questions? All right. Let's move on to the next point. The conclusion for tax savings. Now keep in mind each investment comes with a limitation of the amount of tax that you can save, and at the same time, if you are gaining additional income as a return, then you are going to be eligible for additional tax payment as well. And keep in mind, all these investments comes with some sort of risk as well. There will be risk associated with any kind of investment. The risk might be really small or the risk might be really high, but each investment does come with some sort of risk. You have to keep that in mind as well. Now let's move on to our second topic, that is mutual funds. What are the different types of mutual funds and how are they priced? Okay, so let's first try to understand what are or what is a mutual fund. Okay, generally mutual fund is a pool asset from shareholders, meaning multiple people come together to purchase shares, stocks, or bonds of different companies. Multiple people work together. Generally, you work through professional portfolio manager or investment managers who are going to invest in various different types of investment like equities or bonds or securities or shares, etc., or in stock market. Generally, mutual fund is really good for small or individual investor who don't want to spend a lot of money, lakhs and lakhs of money at once. Usually you can start your investment for as low as 500 rupees in mutual funds. That's going to be 500 rupees per month. That can be, that is one of the most beneficial part of mutual investment. You can opt in for both lump sum amount where you will be spending, you can invest a huge amount at once and wait for the maturity, or you can start with investing really small amount starting with 500 rupees, as low as 500 rupees per month, and then wait for the maturity and keep investing on monthly basis. Now, how does mutual fund works? Let's imagine a scenario. Let's imagine a scenario company like Aditya Birla Mutual Funds, also known as ABFL, started a new mutual fund scheme, and they need about 100 different people for investing because their target is for 1 crore rupees. They want to have, they want to invest 1 crore, they want to collect and invest 1 crore rupees from 100 different investors. Investing 1 crore rupee will be very high amount for one person, but investing 1 lakh rupee per investment, that is into 100, that's going to amount for 1 crore rupees is going to be really easy. So you're getting 100 investor and each investor is paying 1 lakh rupees. Now, let's imagine ABFL is selling each unit for the cost of 10 rupees and they are selling 10,000 units to each investor. So each investor is investing 1 lakh rupee and in return of 1 lakh rupee, they are getting 10,000 units. Each unit is going to be of 10 rupees. Now, the total amount of units that ABFL is going to distribute among 100 people are going to be 10 lakh units. Okay. Now, how does this work? ABFL will take that 1 crore rupee. In return of 1 crore rupee, they will distribute those 10 lakh units, basically 10,000 units per head. And they will take that money and invest in 25 or 30 different stocks, different companies, company shares. Okay. Usually these stocks are not selected randomly. Before investing, ABFL is going to have their fund manager research, study a lot about those companies or stocks where they are planning to invest. They are going to study everything, the risk factor, the company's company's profit margin. What is the trend of the company? Is the company really gaining profits or earning losses, or actually losing money, getting a lot of losses? Usually a company will research a lot before picking or selecting those 25 stocks. Once those 25 stocks are selected, once the fund manager believes that buying stock for these companies are fit and meets all the criterias and should be able to provide proper returns, means proper profit income, then they will go ahead and start creating a portfolio. And once they have selected, they will distribute the money equally between all 25 stocks. So they have 1 crore rupees, and that will be known as assets under management, AUM. So right now you have AUM of 1 crore rupee. They will take that 1 crore rupee and they will submit in between 25 different stocks, which means approximately each stock will get up to 4 lakh rupees. Now keep in mind, this 1 crore rupee did not come from one person. It came from 100 different people. Okay, which means 100 different people invested in those 25 stocks. Okay, and each stock was purchased for 4 lakh rupees. And that is how a company will create a portfolio, and that is how that stock becomes a part of equity funds. Okay, meaning you as an investor will hold a part, a small section of that stock. That section will be known as equity fund. Okay. Now, also fund manager will deal with a lot of different things while investing as well. They will decide what is the amount that should go to one stock compared to their returns, their risk factor, and at the same time, they will decide which stock should get its small amount of investment. And additionally, a fund manager can also withhold some cash amount just so that when an investor is requesting for redemption, basically what it means is when an investor is saying that there is a loss going on, if they're asking for their money back, usually they will use that cash reserve to pay back. Generally, they will use that cash reserve to pay back the for the redemption. But this is how investment happens in mutual fund. They will take a lot of different people, and then they will take money from a lot of people, different people. They will combine the entire amount of money, which will be known as AUM, and they will invest that amount of money in different stocks. This is how generally a mutual fund will work. Now, there is something that is known as net asset value or NAV. Okay, so let's say your mutual fund company has invested 1 crore rupee in 25 different stock each. Again, keep in mind there were 10 lakh units that were sold. Now, the cost of each unit will be known as NAV, or net asset value. Okay. So in this scenario, let's say we have invested 1 crore, sorry, not us, but the mutual fund company has invested 1 crore rupee in 25 different stock that they created as a portfolio, and they have received a return of 25%. That will bring your complete gross investment to 1.25 crore rupees. Now, your net asset value will constantly increase or decrease based on the profit or loss that your mutual fund company is facing. So earlier, when your company invested 1 crore rupee in 10 lakh different unit, the NAV value was of each unit was 10 rupees. As we discussed earlier, the cost of each unit was 10 rupees. So the NAV value of that unit was 10 rupees. Now that the investment portfolio or mutual fund has gained a 25% profit on it, let's say within 1 year, 2 years, or 5 years, then the NAV value of each unit will also increase. It will go from 10 rupees to 12.5 rupees, because the total amount is 1.25 crore rupees for 10 lakh units. Okay, 10 lakh units will be divided between 100 people, meaning each person will have 10,000 units, and each unit will be, no, the new value of each unit will be 12.5, and this is how you will receive your returns, or this is how you will gain your profit from investing in mutual fund. Basically, you purchased one unit for 10 rupees or 10,000 units for 1 lakh rupees. In return, after 5 years or after 6 years, the new net asset value for your unit is now 12.5 rupees per unit, or 1.25 lakh rupees per for 10,000 units. So if you want to make money now, still keep in mind your money is still invested in stock, is still invested in mutual fund bonds. To make withdrawal, to receive your money, you need to sell your portfolio, you need to sell your bonds, you need to sell your units that you have. So you will make a request to your investment company. So for example, we took ABFL as your investment company. You will make a request that you need to sell your bond for so and so reason, and they will sell your units and give you your money back along with the returns or profit that you have gained for that particular investment. So initially you have invested 1 lakh rupees, and this is how you can gain up to 1.25 lakh rupees. Now again, keep in mind, all these investments are just an example, just an example. It all depends on market value. It all depends on market fluctuation, conditions, and everything. Keep in mind, these values change on daily basis, not on monthly basis, not on yearly basis. These values will change on daily basis, and depending on those uh, those fluctuations or variations, you might gain some profit, you might get some loss as well. All these investments come with a risk, so I need you all to keep that in mind. Now, as a result, after investing 1 lakh, after purchasing 10,000 rupees, sorry, 10,000 units for 1 lakh rupees, now your returns are 1.25 lakh rupees, because now your net asset value is 12.5, and you have gained 25,000 rupees as additional returns. Okay, basically you have made 25% profit out of your investment. Any questions on net asset value, NAV, or mutual investments, how mutual investment works, how a mutual investment company works or functions? Any questions or doubts on that? Does anyone have any confusions, or if you would like to, clarify anything, please let me know. Nothing? All right. So now let's talk about redemption. How would you redeem or sell your investment units that you have purchased, and what are the returns that you will get, and what happens when your mutual fund investment company is facing a loss? on your investment. So let's say the overall units that you have purchased were 1 lakh units. Okay. And you would like to sell your 1 lakh units. Then obviously your return will be 12.5 lakhs, 5 lakh rupees. The company will sell your units now and they will give you your appropriate amount of returns. Still, there were 10 lakh units that company used to invest. If they sell 9 lakh units as well, they still have nine, sorry, if they sell 1 lakh unit, they still have 9 lakh unit remaining, and there's still the net asset value or NAV will still be 12.5 rupees per unit. Now, generally, when someone requests for redemption or when someone requests to sell their investment units and give them their money, instead of directly selling those units or stocks, a fund manager will first consider the cash balance that they have maintained, that we have discussed earlier, that a fund manager does not invest 100% of the amount. They will still reserve some amount as cash balance. Now they will try to clear your clear your redemption from the cash balance that they have instead of selling those stocks. Worst case scenario, if they don't have enough cash balance for this portfolio, then they will give you whatever the cash balance is and they will sell the units that they have in the hand, and then they will give you the remaining amount as well. So generally this is how a mutual fund investment companies handle redemption, and this is how generally you can get your money back or your investment back after a set period of time, agreed period of time that you will have to discuss in detail with the mutual investment company that you are going to invest with. Now, what happens if there is a fall on investments? Okay, let's assume the stock prices are falling, the stock market is falling, it's crashing, the rates are going down, the value is going down, and your portfolio, ultimately your portfolio value is also going down. Let's say yesterday your portfolio value, after investing 1 crore yesterday, it turned into 1.25 crore, but suddenly today your portfolio is going down, your net profit or asset value will go down from 1.25 crore to 1.10 crore. Okay, now what happens is you have 9 lakh units remaining after redemption of 10,000, sorry, after redemption of 1 lakh units, you still have 9 lakh units remaining. Those, the remaining net asset value or NAV value, that is of 1.1 crore rupees, will be divided equally between the remaining units, which are 9 lakh units. So the amount will come up to 12.22 rupees or 12 rupees 22 paisa per unit. Okay, now let's say, to help with the losses, to help with the loss, to help increase the portfolio amount, now the investment company, the mutual fund company, can look for new investor, people who are ready to invest in existing portfolios. They will look for those people and they will try to sell additional units to those new investors. But keep in mind, instead of selling 10,000 units per person, this time they will sell lower amount of units for the same amount of money. Last time you got 10,000 units for 1 lakh rupees, but this time the company will sell only 81% of the units, which is 88,183 units for 1 lakh rupees, so that they can even out the losses. So after gaining additional investors, now you will have, or now your portfolio will again increase by 8,183 new units, which ultimately means your not your profit, but your portfolio value has gone up again. Okay, but now you have to keep in mind again, as I mentioned earlier, your NAV, net asset value, changes on day-to-day basis, meaning You can see profit on day-to-day basis, you can see losses on day-to-day basis, or some days the value might just stay steady. Today, let's say the net asset value is 12 rupees and 22 paisa per unit. Tomorrow it can become 11 rupees per unit, or even 10 rupees per unit. Or if the mutual fund company is gaining profit, that NAV value can change to a better amount, maybe 13 rupees per unit, maybe 12.5, uh, 12 rupees and 50 paisa per unit. It all fluctuates on day-to-day basis. So that is why you always have to take a calculated risk while investing in mutual funds. You always have to keep that in mind. Now let's talk about what are the different types of mutual funds are there in the market. You have your equity funds, and then you have your debt funds, and then you have money market funds, you have index funds, you have balance funds, you have income funds, you have your funds of funds, and then you have your specialty funds. Let's discuss about each of these funds one by one. Let's first start with equity funds. Okay, equity generally stands for your stock market or your share market for of different companies. Keep in mind these kind of funds are generally considered as very high risk funds, meaning your investment will be very high risk. Your investment can see huge returns, but at the same time your investment can also suffer from huge losses as well. Usually equity funds are very fast moving funds, okay, meaning it can change from day to day basis or on hourly basis depending on what kind of company it is, what kind of business it is, and what is the current condition of that company where you're investing. Equity funds can give you huge returns as well if the company is was successfully able to gain huge amount of profit. Then you will get high amount of returns as well. You can get as high as 27% return profit returns on your investment as well. Meaning, let's say if you submitted invested 1 lakh rupees in an equity fund and that company was successful, then you might even get up to 27% percent of profit, meaning you might get 1,27,000 in return as well as profit. But keep in mind it is very risky because at the same time the company can go into loss extremely fast. Let's say if the company is going in loss and you have invested 1 lakh rupees and the company suffered 10% loss, meaning instead of getting your 1 lakh rupee you might even just get 90,000 rupees in return as well. It can change on day to day basis. Next, you have your debt funds. Debt funds are considered a little bit more secured compared to equity funds. It can change on day-to-day basis as well, but again, usually debt funds are allotted to companies who are providing a lot of debt ventures or government bonds or fixed income asset bonds. Usually usually investment does not attract any kind of liability or very small amount of liability. And at the same time, if you're gaining any returns, you will have to pay tax on those returns as well. So these two are one of the most famous or one of the most popular investment for mutual funds. Do you have any questions or doubts and anything on this or on today's session? Any questions, any doubts, anything? All right then. So Ayushi, I believe we can close the session for the day. Ayushi, can you hear me?